What is an all-in-one ETF, also known as an asset allocation ETF? They are highly diversified ETF portfolios that consist of multiple ETFs with domestic and global exposure. So they are supposed to be a one-fund solution to your entire investment portfolio. These low-cost assets are designed with a target asset allocation in mind and include regular rebalancing. They are the middle ground of ETF investing between robo-advisors and DIY ETF portfolios. They aren't as passive as robo-advisors, but are cheaper, and they are more passive than DIY ETF portfolios, but cost a bit more. Now, there really isn't one all-in-one ETF that's the best. Everyone has different risk tolerance, time horizons, values, and even tax situations. So really, you need to find the best all-in-one ETF for you. I can't tell you what your asset allocation is, but I can show you the main differences between each provider so you know where to start. So let's take a look at the all-in-one ETF providers available on the TSX, suited for Canadians. Vanguard. This provider currently offers 6 asset allocation ETFs. This includes the retirement income, conservative, balance, growth, and all equity portfolios. Vanguard is the most popular choice in Canada by net assets. This may be due to the reputation of Vanguard being a pioneer of lower fees and innovative products like these all-in-one ETFs. Also, these ETFs offer lower currency volatility, the highest diversification, and offer more exposure in Canadian markets. And although they are one of the largest asset managers in the world, they are not publicly traded. The next provider, Blackrock, a publicly traded company. They currently offer 5 asset allocation ETFs, the same as Vanguard minus the retirement income fund. But they also offer ESG versions of the conservative, balanced, growth, and equity portfolios. So if you value sustainable investing, Blackrock is your solution. Now, a reason why you might want Blackrock over Vanguard is because of their slightly better performance and lower MER fees. This might be due to the heavier weight in the US markets and a lower weight in the emerging markets. Also, BlackRock has a longer track record being the first provider to offer asset allocation ETFs in Canada. And unlike Vanguard, these ETFs offer PAC for automatic purchasing of shares. Next, our very own BMO. You may want to choose BMO over the others just because it's a Canadian company. They currently offer 6 asset allocation ETFs: conservative, balance, ESG balance, growth, all equity, and monthly income. BMO's ETFs are very similar to Vanguard and BlackRock's. Honestly, the difference between the 3 providers so far is very minuscule. Don't focus too much on the MER fees and holdings, but consider things like, does my broker offer commission-free trading of the ETF in question? If not, it's worth switching to a brokerage that doesn't have commission fees. Cue the Wealthsimple plug. Video description. Another player in the ETF game is Horizon, but they play this game differently. Their underlying ETFs are swap-based ETFs, which essentially means they are more tax efficient. Instead of a dividend payout, it's converted into capital gains. This makes this ETF more suited for large portfolio, high tax bracket individuals using a taxable account or for corporate accounts. Their holdings are quite different, with currency hedging for foreign equities, overweight in US equities, and underweight in Canadian equities. This makes their portfolios much more aggressive than its competitors, which can mean higher highs but lower lows. And although they have the lowest MER fees, they also have a swap fee that actually puts their ETFs on the expensive side. You'll need to do additional research on Horizon to see if these ETFs are more beneficial to you. Also consider that the government is trying to shut down this structure of ETF, which could mean an expensive capital gain bill. TD also has their own one-click ETF portfolios. These ETFs use a different strategy than the rest. They are actively managed, which isn't favorable in these types of ETFs. But if you use TD's Goal Assist, you're able to trade these ETFs for free, which is the only reason to justify going with these funds. Another actively managed provider is Fidelity. The only reason to choose this provider is if you want exposure to cryptocurrencies. But this, plus the higher fees, will more likely deter investors. And the last provider of these ETFs, Mackenzie. This one also claims to be actively managed, but are actually passive like the Vanguard, BlackRock, and BMO ETFs. You may want to choose Mackenzie over the others because they have a more tax-efficient strategy and they currently have the lowest MER fees of them all. But consider that these ETFs are quite new, with lower net assets, lower trading volume, and a higher bid-ask spread. If Mackenzie had a longer track record, they could be a much bigger player in the game. So for now, just keep this one on your radar. The provider you choose is less important than choosing the right target asset allocation. But sadly, there is no one perfect asset allocation. Everyone's will be different. The main thing is that you consistently invest and grow your portfolio. If you want to continue learning, check out one of the videos on the right of the screen. Thanks for watching. Until next time, keep making money moves. Peace!